Welcome back. Thank you so much for staying tuned in. Well, let's take a look at some more news and updates. Then SEBI has released a consultation paper on steps to increase investor protection in derivative markets. My colleague Ankur Mishra is joining in with more details. Ankur?
Yes, SEBI has released consultation paper on FNO, and the idea is investor protection as well as market stability. One of the suggestions which has been given is to increase the contract size and the minimum size can be between 15 to 20 lakhs as per suggestion. Currently that lot starts from rupees 5 lakh, and in the second phase, that is after 6 months of the implementation of phase 1, the contract size, the lot size can be increased to rupees 20 to 30 lakh. Apart from that, there are also few of the suggestions which has been given, especially for weekly expiry contract. The suggestion is that weekly options contract should be provided on single benchmark index of an exchange. There is also a suggestion that not more than 50 strikes to be introduced for an index derivative contract at the time of contract launch. And there is also often seen that since the expiry approaches, the margin is triggered sometimes for buyers. So this time there is a concept of ELM, that is extreme loss margin, which can be introduced. Now for this, before the day of the expiry, the ELM can be levied at 3%, and at the start of the expiry day, ELM, that is extreme loss margin, to be increased to 5% on the expiry day. So all these suggestions has been given keeping a retail investor in mind. This consultation paper was in works for long, and finally now it is up for suggestions of the stakeholders.
All right, Ankur, thanks so much for taking us through all the details about that SEBI consultation paper coming in. But let's also go across and listen to what Rajesh Baheti of Cross Seas Capital Services and Ajay Bagga, market expert, had to say on this.
It will directly hit the lowest rung of retail, enable only people with more money to trade in the markets, and the brokers will also be more careful because when the lot sizes are bigger, they'll have to be careful as to who they onboard for the F&O segment because the profits and losses can get bigger. So that will be the most effective measure. Where I have the biggest problem with this thing is the guideline where it proposes one expiry per exchange. Rather than making it one expiry per exchange where the NSE has to effectively choose between the bank Nifty and the Nifty, they might have, or they might be better served if they make it one weekly expiry day per exchange.
Intent is good in terms of what SEBI is shooting for. What it does is, with the lot size increase, I don't agree with it, but I think it's going to happen now, so might as well fall in line. What it will do is, it will remove a huge portion of very small traders from the market, and who were probably making losses because you need some amount of capital and staying power to be in this F&O market. So that is a welcome move. It will reduce the access to a lot of small traders. The issue that I foresee, one, as you reduce volumes because of this, the genuine hedging will also become more expensive, and it will not find volumes. So what will happen is the small trader will move to the cash stocks, the penny stocks on a day-to-day basis, while the F&O market will see volumes going down. So genuine hedging as well will become more expensive and will be more difficult to execute. That is one issue. So you are making the market more shallow.